Good afternoon, and welcome to McGuireWoods' SEC Compliance and Disclosure Update. I am Katie DeLuca, a partner in the firm's Securities and Capital Markets Department and the moderator for today's program. McGuireWoods is a full-service law firm with more than 1,100 attorneys in 21 worldwide offices. Our more than 50 securities and capital markets lawyers represent some of the nation's largest business and financial institutions. We regularly serve as counsel in public and private securities offerings and help clients understand and address unique securities compliance issues and reporting requirements. Recently named Banking and Finance Law Firm of the Year by Law 360, McGuireWoods consistently ranks among the top law firms for representing clients in capital markets transactions. Before we begin today's program, I would like to call your attention to the Q&A icon in the lower left-hand corner of your screen. Please feel free to use this widget to submit any questions you may have for our panelists at any time during the program. We will do our best to address your questions in the time allotted. However, if we are unable to do so, we will follow up with you by email. You will find a number of additional resources along the bottom of your screen, which we encourage you to explore during the presentation. Notably, the Meetings Materials folder includes a copy of today's presentation slides. With those housekeeping items complete, allow me to introduce our first speaker, Jay Anderson. Jay is based in our Richmond office and represents public and private companies in a broad range of corporate and securities law matters. Jay will provide a summary of recent SEC Commission guidance on key performance indicators and metrics in your company's MD&A. Jay?
Thanks, Katie. Yes, I'm going to be talking the first of three presentations today that relate to MD&A with regards to some items that SEC staff has come out with. I'm going to cover two items related that touch on MD&A. First, in late January, the staff issued three new CDIs that were intended to provide some clarity to 2019 FAST Act rule changes. And then secondly, going to be discussing SEC Commission guidance that came out the end of January. It was effective a couple of weeks ago on February 25th, really providing some guidance relating to key performance indicators and metrics. On the CDIs, some background here. The FAST Act rule changes allowed a company to omit discussion of the earliest of 3 years in MD&A if your prior filings with the SEC already contain this information and the discussion was not necessary to understand the company's financial condition, changes in condition, and results of operation. If you were going to admit the discussion, the FAST Act required you to make a statement or a legend identifying the location of the discussion in a prior filing. So the SEC staff must have gotten some questions regarding this, so they recently put out these three CDIs. The first CDI just basically goes for the proposition that the statement merely identifying the location in a prior filing where the omitted discussion can be found doesn't necessarily incorporate by reference that disclosure unless the registrant expressly states that the information is incorporated by reference. So if you don't want it incorporated by reference, you don't need to say anything. It isn't incorporated by reference. Secondly, for shelf registrations, when a registrant uses its 10K as its 10A3 update and its 10K for the given year omits the 3-year discussion and includes the location disclosure, then when you file that 10K, the registration statement only incorporates by reference that 10K, so that doesn't include the year 3 discussion. And last, I think this was just sort of a highlight again to one of the things the SEC mentioned in the FAST Act was that you can't rely on this new instruction to get rid of year 3 if you do believe that the discussion is necessary to an understanding of the financial condition, changes in financial condition, and results of operations. So I think that last one is just sort of more of a reminder to folks that if you're getting rid of that year 3, to make sure you think that through. Moving on, I think a little bit more importantly is the SEC guidance related to key performance metrics in MD&A. This one started off with a reminder to folks that you're supposed to be using the existing MD&A requirements, such as to make sure that your narrative, like in your trends and uncertainty section, your outlook, or maybe your summary section, is allowing investors to see the company through the eyes of management, and wants to make sure that your use of metrics sort of matches that use through the eyes of metrics. So if management has material key performance metrics that it uses to run the business or in strategic decision making, the SEC staff believes that that is something that should be considered strongly for MD&A disclosure. Now, the SEC started with this guidance talking about how issuers are all over the map with regard to what key performance metrics they use, that they vary from company to company, from industry to industry, and are really sort of highly sort of facts and circumstances based. The SEC mentioned that there are lots of examples and various different types of examples that folks use. Some use external or macroeconomic matters, some use company industry-specific matters, and some use sort of a combination of external versus internal. The staff also went forward to discuss that some specifically, they wanted to mention that environmental metrics are used, such as metrics regarding the observed effect of prior events on their operations. And then the staff gave a whole list of various different examples, and I think they provided this list, and this is just a portion of the list, just to make sure that everybody's thinking about what they're meaning here with these key performance metrics. Others that they mentioned specifically include active customers, total impressions, traffic growth, voluntary or involuntary employee turnover rate, and so forth. So those are the items that the SEC is sort of talking about here with this guidance. It's really a wide range of items to be thinking about and considering with regard to sort of the expectations the staff has when you use these items. Now, they gave a list of sort of general expectations when you use these items to consider existing MD&A requirements, and to make sure that you are providing enough information so that the metrics use is not materially misleading, and then gave a bunch of bullet points to think about with regard to your disclosure of these metrics. First, does an existing regulatory disclosure framework apply? If it's a GAAP number, you need to be thinking about the GAAP disclosures. If it's a non-GAAP financial measure, key performance metric, then Reg G or Item 10 of SK would trigger. So first, when you look at the metric, is there already rules that frame what your disclosure should be looking like? Then, sort of more generally, think about the context to make sure that the investor understands the metric and how it's used by management. Think about providing a clear definition of the metric and how it's calculated if there are inputs that aren't obvious. Think about adding a statement regarding how it provides useful information to investors and how management uses the metric in monitoring or managing the performance. And then when you use estimates or assumptions are built in, think about whether disclosure of those items is necessary. I'm not sure what the feedback is on that. All right, hopefully that'll end. Okay, going on to sort of. Yeah, is everybody on mute? Okay, so if there are changes to the calculation or the presentation of a metric, you need to think about whether that triggers sort of additional disclosure to the extent material. Think about the differences in the way the metric was calculated during this time and prior periods, why you made changes to the calculation, the effects of changes, and if there are other more significant types of changes, to consider whether it's necessary to recast prior metrics to conform the current presentation and place the disclosure in the appropriate context. Last, in the guidance, the SEC wanted to make sure that it was provided a reminder on effective disclosure controls, that when you're using key performance indicators and metrics, to make sure that the registrant is still using and conforming their effective disclosure controls and procedures, especially with regards to consistency and accuracy of use regarding these type of metrics. So I think the takeaways on this are a few. First, I think it's a good place to stop, and a lot of companies have been using the same metrics over a long period of time. Think about whether the metrics you are disclosing are actually the metrics that management uses. Review your disclosure practices for key metrics, especially I think folks are going to be beginning to be expanding their disclosures surrounding the key metrics, especially when changes are made to hit the points in the SEC guidance. And also remember that this is not just picking up financial metrics. There are specific ESG metrics that the SEC put into their release that folks are reporting on in their 10Ks, and if they're important for management to make sure that this guidance applies. And lastly, just think about the fact this is a new guidance from the SEC. It's probably a heightened SEC comment area as well. To sort of think about and make sure that you're conforming your presentation to guidance. That's all I have.
Thank you, Jay. Our next presenter is Rakesh Gopalan, a partner in our Securities and Capital Markets Group and co-chair of the firm's FinTech practice. He regularly handles public company and securities issuances and reporting requirements, private and public, company mergers and acquisitions, and other corporate and transactional matters. Rakesh will discuss the SEC's recent disclosure guidance on IP and technology risks.
Thank you, Katie. In December, the SEC's Division of Corporation Finance issued guidance on IP and technology disclosure considerations for companies that have international operations and international vendors. This is a continuation of the SEC's focus on various technology and cyber liability issues. Previously, they focused on topics such as cyber risk disclosures, data breach, which they also get into here, risk factor considerations, and things of that nature. One thing to keep in mind is that this is guidance. It's not binding, and it does come from one division, an important division, but just one division of the SEC. So it can't be relied upon. These are not safe harbors, but merely guidance and disclosure considerations that companies should consider while they assess their disclosures. The guidance focuses on international operations, as I mentioned, and particularly when companies are operating and have vendors and counterparties and development initiatives in countries that they refer to as with low levels of IP protection. The purpose of the guidance, according to Corp Fin, was the increasing reliance on technology and technology assets being housed or originated in countries outside of the U.S. So the guidance provides a number of specific examples where there might be IP risks, IP theft, cyber and physical theft. Although they do reference physical theft and the adequacy of security measures around a physical facility in which your IP or technology or data may reside in a foreign jurisdiction, the thrust of this does seem to be cyber theft, cyber incidents, and particularly indirect risk. One of the themes, I think, is that they highlighted to companies to focus on partner organizations and other counterparties with whom you do business, instead of simply focusing on the assets and the physical locations that might be in-house. Many companies have robust processes surrounding vendor risk management. In some industries, such as financial services industries, those companies have very specific guidance from the OCC and other regulators as to how to manage vendors and how to assess the location of information and data. And some companies, particularly those who are not as regulated and who do not have as robust of a process, have a little bit of exposure or a little bit of improvement that they can be making in terms of assessing how to do business and whether to do business with vendors across the globe. One of the things that guidance focuses on is whether you have relationships with vendors or other counterparties in certain jurisdictions where, as a condition of doing business in that jurisdiction, the company has to relinquish certain rights, either to improvements or they have to agree to certain onerous terms that favor the local party, local ownership requirements. One of the things that they mentioned was in a joint venture relationship with a party outside of the U.S. in a foreign country, there are sometimes requirements for that country to have, for the joint venture to have a control or a majority ownership stake by a local individual to that local country. And in some instances, the foreign jurisdiction requires submission to a set of local regulatory requirements that are often less than clear, but give a lot of power and authority to the regulators. And so all of that is to say that in addition to the normal processes that a company should put in place to decide whether it's appropriate to do business, whether it's economically viable and commercially advisable to do business with counterparties in other jurisdictions, inserting a level of legal and compliance review at the outset, not towards the end of the award or the bid, is critical. And that would involve, or could involve, including internal resources, internal legal department, external counsel, but particularly foreign counsel. And that's, I think, what the SEC is identifying. The Division of Corporation Finance is identifying the gaps in knowledge relating to certain local jurisdiction and local laws that may come back and create adverse consequences to companies. The guidance goes on to state that the purpose of the guidance is to encourage companies to assess those risks relating to theft and compromised data and IP, whether it's related to a specific jurisdiction, whether it's related generally where the data and IP are housed or created, and a reiteration of a theme that is really part of the normal principles-based disclosure requirements in risk factors and MD&A generally, is that they state that where material, those risks should be disclosed and be specifically tailored to the business. And again, that is nothing new. It is a normal risk factor. It's part of the risk factor disclosure regime. The risk factors need to be individualized to the specific company, and generic risk factors that apply to all companies in that space, or all companies generally, are generally disfavored by the SEC. That said, if you inventory public company disclosure on risk factors, there are still many risk factors that probably would apply to all companies that are included as a measure of protection and risk mitigation. And that's something that is a balancing act that you and your internal and external counsel will have to look at. Another item that was mentioned was that not only should the risks, the hypothetical risk, be included and disclosed, but to the extent that there are actual breaches, it requires a reassessment of materiality and updated disclosures. So this is almost directly out of Facebook, and there are a couple other companies as well, but particularly Facebook, where they agreed in connection with a $100 million July 2019 settlement. The facts underlying the SEC's claim against Facebook was that their disclosures in the risk factors focused on hypothetical data breach issues when they knew that there were some data compromises related to the Cambridge Analytica scandal. The guidance includes a laundry list of questions for companies to consider. So again, this is not telling companies to specifically do or not do something in a securities filing, but rather to identify and include in the process, whether it's through your disclosure committee or your audit committee or your cyber committee, risk committee, what have you, to include in that process and those meetings considerations and discussions about some of these topics, including whether the company has a heightened risk just due to the fact that they have foreign operations, whether there are specific jurisdictions that are worse than others from a data and IP protection standpoint as against U.S. companies, transferring information with a governmental entity, granting rights, future improvements to foreign parties, joint ventures, as I mentioned earlier, yielding IP rights as a condition to access to markets, enforcement mechanisms that might be curtailed, limitations on export of data once your data is housed in a foreign jurisdiction and modified or manipulated. Getting it back sometimes is a challenge. And generally, whether the company should assess whether they have proper controls to protect IP and identify those risks and detect issues arising from whether it's employees or insiders, espionage, or other types of unauthorized access. Finally, the guidance mentions that companies should consider the appropriate level of risk oversight by the board and executive officers and what role they play when incidents do occur. And I do see in the last several years companies taking a more concerted effort as to creating a process and involving IT subject matter experts, information security subject matter experts directly in front of audit committees and risk committees to make sure that the responsibility and the oversight over what used to be this purely technical area relating to technology is now front and center for most public companies. Again, it's a principles-based disclosure system, so no hard and fast rules as a result of the guidance. And the guidance did mention that there might be other disclosure regimes that might govern these issues. All right, Katie?
Thank you, Rakesh. Presenting next is Erin Berquist. Erin is a Securities and Capital Markets Associate in our Richmond office. She focuses her practice on corporate law, including securities compliance and capital markets. Erin will be discussing the SEC's proposal to update certain financial disclosure requirements in Regulation SK and with implications to your MD&A. Erin?
Thanks, Katie. So today I'm going to go through the SEC's proposal to update and amend certain items in Regulation SK and MD&A. So just a little bit of background on the proposed amendments to Regulation SK. The amendments kind of come about as part of a comprehensive evaluation performed pursuant to the SEC staff's December 2013 report on review of disclosure requirements in Regulation SK. That included an assessment of required disclosures, where and how the required disclosures are presented, and the SEC's increasing use of technology, basically to improve efficiency. Also, the FAST Act, which came about and this required the SEC to examine ways that Regulation SK could be modernized and simplified. So kind of the objectives, the overarching objectives of the proposed amendments are to eliminate duplicative disclosures, to modernize and enhance management discussion analysis, MD&A disclosures for the benefit of investors, and to just simplify compliance efforts for registrants kind of in general. So the proposal proposes, it was released on January 30th, 2020. It proposes the elimination of a few Reg SK requirements. So first, the elimination of item 301, the selected financial data. Registrants would no longer be required to provide 5 years of selected financial data. So the objective there would be just to modernize and simplify disclosures in light of technology development. They're also proposing to eliminate item 302, which is supplementary financial information. So registrants would no longer be required to provide 2 years of selected quarterly financial data or information about oil and gas producing activities. That would also be subject to the finalization of related amendments to the GAAP requirements by FASB as well. So the objective there is just kind of, yet again, to reduce repetition and then focus on the disclosure of material information, instead of providing all this information, again. Finally, elimination of item 303A5, which is the tabular disclosure of contractual obligations. Registrants would no longer be required to provide a contractual obligations table, given the overlap with certain information that's required in the financial statements. So, yet again, the objective here really is just to promote the principles-based nature of MD&A and to help reduce redundancy and just kind of increase efficiency, in the disclosures. So then we move on to amendments to item 303 that have been proposed, which is to MD&A. So the first big amendment they're proposing is the addition of new item 303A, which is going to be called objective. This would kind of describe the principal objectives of MD&A, which is going to be helpful for investors. It incorporates basically the substance of current instructions 1, 2, and 3 and codifies SEC's guidance of encouraging registrants to provide a narrative of its financial statement so that investors can kind of, see what management is doing or see through the eyes of management. So, the overall objective here is kind of just emphasize the general purpose is to provide a historical and prospective analysis of a company's financial condition and results of operations with also an emphasis on the future prospects of the company. And then current items 303A and 303B would be kept as well, and they would just be renamed 303B and 303C since there's going to be the new addition of 303A. The next amendment that's being proposed is the replacement of current item 303A4, which is off-balance sheet arrangements. So the current item requires off-balance sheet disclosure to be in a separate section and contains requirements that overlap with GAAP. The replacement item that's being proposed would be a principles-based instruction that is intended to encourage registrants to discuss off-balance sheets arrangements kind of in the broader context of MD&A when the obligations either have or are reasonably likely to have a material effect. So it's kind of just focusing yet again on the materiality aspect here. And so the objective is just to integrate disclosure within the context of MD&A. Next proposed amendment is the addition of new disclosure requirement to item 303, which is the critical accounting estimate. So this codifies SEC guidance by requiring disclosure of critical accounting estimates, which are basically defined as estimates that are made in accordance with GAAP that involve a significant level of estimation uncertainty and have had or are reasonably likely to have a material impact on the registrant's financial condition or results of operations. And then if these are material, the company would be required to disclose why the estimate is subject to the uncertainty, how much the estimate has changed, and then the sensitivity of the reported amounts. It requires also the quantitative information that's reasonably available and would provide material information to investors as well as qualitative information. Yet again, I think that the objective here is, meaningful analysis and also kind of goes back to materiality and kind of just trying to make everything more efficient. The next amendment to 303 is revision to the interim MD&A requirement in current items 3 through 3B, so interim periods. This would allow companies to compare the results of operations for their most recently completed quarter to either the corresponding quarter of the prior year, which is what's currently required, or to the immediately preceding quarter. If a registrant would, decide to switch its basis based on this new, the availability of this new rule, then the registrant would be required to discuss the reasons that they made the change, and then also, when the change is first made, they would be required to provide both comparisons. So I think this is kind of just trying to allow for flexibility and the ability to, for investors to have better disclosure. More additional amendments to item 303. So another amendment that's being proposed is to instruction 4 to current item 303A. So the purpose of this amendment is to clarify that MD&A requires more of a narrative discussion of the underlying reasons for the material changes in one or more line items in quantitative and qualitative terms. So yet again, just kind of trying to enhance the analysis aspect of MD&A. And then the next amendment that's being proposed is to item 303A2, which is capital resources. So this amendment specifies that a registrant should broadly disclose material cash commitments, including but not limited to capital expenditures, as of the latest fiscal period, the anticipated source of funds needed to satisfy the requirements, and then the general purpose of the requirements. So the objective here, I think, is just to modernize disclosure to account for capital expenditures that might not necessarily be considered capital investments. The next amendment that's being proposed is item 303A32, which is known trends or uncertainties. So this will be changed to when a registrant knows of events that are reasonably likely to cause instead of will cause a material change in the relationship between costs and revenues, and the reasonably likely change must be disclosed. So this is kind of just getting towards consistency with interpretive guidance that's been put out there on forward-looking statements. So the reasonably likely language, this change just kind of brings it more in line with that. The next proposed amendment is item 303A33, which is net sales and revenues. So this would just clarify that a results of operations discussion should not only include increases, but also decreases as well. And this is, yet again, just trying to codify the existing commission guidance that's out there on those items. So finally, the last two amendments that are being proposed, item 303A3, 4, this would eliminate the requirement for registrants to discuss the impact of inflation and changing prices or material along with the related instructions. Kind of, yet again, is just really focusing on, having registrants focus on material information that's tailored to their business and circumstances instead of having to have all these other disclosures that might not necessarily be that useful for investors. And finally, item 303C, that's the safe harbor for forward-looking information, and D, which is for smaller reporting companies. These are just conforming changes that are being proposed. It's not going to alter the availability of the regulatory safe harbors that are out there for forward-looking information and MD&A. That's still going to be available. That's still there. This is just kind of, conforming it to the other amendments that are being proposed. So kind of the key takeaways here is basically most of the proposal has to deal with amendments to item 303, which is MD&A, but there are also proposals to eliminate item 301 and eliminate item 302 as well, which deal with the financial data and supplementary financial information. And basically, overall, the main objectives are just to kind of increase efficiency, eliminate the duplicative disclosures, modernize MD&A, in accordance with the technology that's out there, and basically just trying to simplify the compliance efforts for registrants, and then also have all these disclosures be more beneficial to investors.
Great. Thank you, Erin. Next up, we have Nova Harb. Nova is counsel in our Securities and Capital Markets group and is located in our Jacksonville office. Nova focuses primarily in the areas of business and corporate law with an emphasis on federal and state securities laws, mergers and acquisitions, and corporate governance. Today, Nova will be discussing the SEC's proposed rule amendments to the definition of accredited investor. Nova?
Thank you, and good afternoon. As Katie mentioned, I'll be discussing the SEC's proposed amendments to the definition of accredited investor. The accredited investor definition is a central component of several exemptions from securities registration, including the traditional private placement exemption under Rule 506B and the newer advertised private placement exemption under Rule 506C. Qualifying as an accredited investor in these types of offerings is significant because accredited investors may participate in investment opportunities that are not generally available to non-accredited investors. The definition is also used in determining investment amount limits in other exempt offerings, including offerings made under Tier 2 of Regulation A, and it plays an important role in other federal and state securities law concepts, including the thresholds for registration under the Exchange Act. In June 2019, the SEC issued a concept release on the harmonization of securities offering exemptions, in which it requested comments on possible approaches to amending the definition of accredited investor. The concept release was preceded by a staff report on the accredited investor definition issued in December 2015. The staff report examined the history of the definition of accredited investor and considered comments and recommendations from the public and those of various committees, including the Commission's Investor Advisory Committee and the Advisory Committee on Small and Emerging Companies. The staff report was prepared after Dodd-Frank directed the SEC to review the accredited investor definition as it related to natural persons at least once every 4 years to determine whether the definition should be modified. The SEC received over 50 comment letters on the 2015 staff report. The proposed rule we're discussing today reflects these comments and considerations. Let's start by reviewing the current definition of accredited investor. The current definition of accredited investor contains 3 categories in which a natural person can qualify as an accredited investor: the net worth test, the income standard, and the relationship standard. Under the net worth test, individuals are accredited if their net worth or joint net worth with their spouse exceeds $1 million. There are a few nuances in the calculation of net worth, but for now I'll simply say that the calculation excludes the value of the primary residence. Under the income standard, individuals who have income exceeding $200,000 individually or $300,000 with their spouse in each of the last 2 years are accredited, as long as they expect to reach the same income level in the current year. In addition, directors, executive officers, and general partners of the issuer are considered accredited investors based on their relationship with the issuer. The accredited investor definition also includes several categories for entities. One of the more common categories includes certain entities such as corporations, partnerships, and 501c3 organizations that have more than $5 million in assets and that were not formed for the specific purpose of acquiring the securities offered. Trusts with more than $5 million in assets are also accredited investors if they were not formed for the purpose of acquiring the securities offered and their purchase is directed by a sophisticated person. Now you'll note that LLCs are not included in this list because they were not a common form of entity at the time the accredited investor definition was originally adopted. But the SEC has since extended guidance that applies the 5 million asset test to LLCs, and we'll see in the amendments that they'll expressly include LLCs going forward, assuming these rules are adopted. So moving down the list, entities that are owned by all accredited investors also qualify as accredited investors themselves. In addition, various ERISA employee benefit plans and certain state employee benefit plans are accredited investors, and I've summarized at the bottom of this slide those categories for your reference. Other entities that are accredited investors are listed on this next slide. They include banks and similar financial institutions, registered broker-dealers, insurance companies, and registered investment companies, among others. On December 18, 2019, the SEC proposed amendments to expand the definition of accredited investor. The proposed amendments add new categories of individuals and entities who qualify as accredited investors and make clarifying changes in the definition. The proposed amendments also make conforming changes to the definition of qualified institutional buyer, also known as QIB. Although increases in the dollar thresholds for the net worth and income accredited investor tests have been a big point of discussion among the SEC and commenters for quite some time now, the proposed amendments did not include any changes to those thresholds. So looking at the proposed amendments here, they would add a new category for individuals to qualify as accredited investors based on their having certain professional certifications, designations, or other credentials that demonstrate a background and understanding in the areas of securities and investing. The qualifying certifications, designations, and other credentials would be designated through an SEC order rather than listed in the rule itself, which gives the SEC the flexibility to evaluate the criteria on an ongoing basis. While the proposed rule did not detail the initial list of these professional certifications, designations, and other credentials, the SEC indicated in the rule release that securities professionals who have a Series 7, a Series 65, or Series 82 license would be expected to be included. Under the proposed rules, an individual would be required to maintain these certifications, designations, and credentials in good standing in order to qualify for the accredited investor status. I also want to note here that these individuals would be considered accredited investors even if they do not meet the net worth or the income tests that are otherwise applicable to individuals under the accredited investor exemption. The proposed amendments would also allow knowledgeable employees of a private fund to qualify as accredited investors for investment in the fund. A knowledgeable employee under the proposed amendment would have the same definition as in the Investment Company Act rules. This group includes executive officers, directors, trustees, advisory board members, or other persons serving in a similar capacity of a 3C1 or 3C7 fund or its manager, as well as employees of the fund or its manager who in the normal course of their duties have participated in the investment activities of the private fund for at least 12 months. Employees that perform solely clerical, secretarial, or administrative functions are excluded from the definition. The proposed amendments would also add to the definition of accredited investors, investment advisors that are registered under the Investment Advisors Act and or registered under the laws of the various states, limited liability companies that satisfy the other requirements of the accredited investor definition, and rural business investment companies. Additionally, the proposed amendments would add a new catch-all category of accredited investor to capture any type of entity owning investments in excess of $5 million that is not formed for the specific purpose of investing in the securities offered. The SEC proposed this new catch-all category to cover existing types of entities not specifically enumerated in the definition, such as Indian tribes, labor unions, governmental bodies and funds, and foreign entities, as well as entity forms that may be created in the future. The proposed amendments would also add a new category to the accredited investor definition for a family office with at least $5 million in assets under management, and that would extend also to its family clients. The amendments would apply only to a family office whose purchases are directed by a sophisticated person. The SEC also proposed a few clarifying amendments in the proposed rule. Under the current rule, an individual, together with his or her spouse, may qualify as an accredited investor by either having at least $300,000 in joint income in the 2 most recent years, with an expectation to earn the same amount in the current year, or by having at least $1 million in joint net worth. The proposed amendment would broaden both the income and net worth criteria to include spousal equivalents. In other words, a cohabitant occupying a relationship generally equivalent to that of a spouse, so that the income and net worth of spousal equivalents would count towards these tests. The other clarifying amendment in the proposed rules relates to the look-through of entities under the all-accredited equity owner category for entities. Under the existing rule, an entity qualifies as an accredited investor if all of its equity owners are accredited. The proposed amendment clarifies that it's permissible to look through multiple layers of equity ownership of an entity to natural persons to determine whether all of the equity owners of that entity are accredited investors. The proposed amendments would also make conforming changes to the definition of qualified institutional buyer. Rule 144A provides a non-exclusive safe harbor exemption from the registration requirements of the Securities Act for resales of certain restricted securities to QIBs. In response to investor concerns and to avoid inconsistencies between the entity types that are eligible for accredited investor status and QIB status, the SEC has proposed to expand the QIB definition by adding rural business investment companies and limited liability companies to the list of entities covered by Rule 144A. In addition, the proposal would reflect a new catch-all category in the proposed accredited investor definition for entities owning investments in excess of $5 million that are not formed for the specific purpose of acquiring securities, as well as any other entities that may be added to the accredited investor definition in the future, provided that these entities would also have to meet the $100 million in securities owned and invested threshold to qualify as QIBs. And finally, I wanted to look at a few potential effects of the proposed amendments, which are highlighted on this next slide. The proposed amendments could potentially benefit issuers conducting exempt private offerings under Rule 506B and Rule 506C by expanding the pool of accredited investors, improving the ability of issuers to raise capital in the exempt market, and reducing the competition between issuers for investors. Also, because accredited investors are not subject to investment limits under Tier 2 of Regulation A, expanding the pool of accredited investors could enable issuers that are conducting offerings under Tier 2 to raise capital faster and at a lower cost. The expansion of the QIB definition under Rule 144A would increase the number of potential buyers of Rule 144A securities from financial intermediaries, which could facilitate capital formation in this market by issuers conducting Rule 144A exempt offerings and increase the resale and liquidity of securities issued in these types of offerings. The proposed amendment could also facilitate resales under regulation crowdfunding during the one-year sale restriction period, since securities purchased in a crowdfunding transaction generally cannot be resold for 1 year unless they're transferred to an accredited investor. This can make it easier for holders of those securities to find a buyer, potentially leading to a lower liquidity discount. Another potential benefit to issuers interested in raising capital through Rule 506C offerings is that the proposed amendments would provide them with additional ways to verify an investor's status as an accredited investor, such as through professional certifications, which could ease some of the challenges that issuers face in complying with the verification requirement. In addition, under Section 12G of the Exchange Act, an issuer other than a bank is required to register a class of equity securities under the Exchange Act if on the last day of its fiscal year it has more than $10 million in total assets and securities are held of record by 500 or more persons who are not accredited investors. To the extent that the proposed amendments increase the pool of accredited investors, issuers may be able to raise the capital that they need by selling securities to fewer non-accredited investors, which could enable these issuers to avoid becoming an Exchange Act reporting company for a longer period. Finally, a proposed amendment to the accredited investor definition would allow knowledgeable employees of private funds to qualify as accredited investors for purposes of investing in offerings, which would potentially allow these private funds the ability to provide their knowledgeable employees with some skin in the game. That's all I've got for today. We'll keep you updated if and when the SEC adopts final amendments to these rules.
Thank you, Nova. Our last presenter today is Kendall Manning. Kendall is an associate in our Securities and Capital Markets group and located in our Charlotte office. Her practice focuses on mergers and acquisitions, securities, and other corporate matters. She will provide an update on board gender diversity today. Kendall?
Thanks very much, Katie, and good afternoon, everyone. As mentioned, I'll be discussing board gender diversity today, and more specifically, we will be looking at a recent California law that requires companies to have at least one female board member. This law is the result of legislation that was signed in September of 2018 by former California Governor Jerry Brown. It is known as Senate Bill 826, and it added a new section of the California Corporations Code that went into effect on January 1st of 2019. Specifically, this new California law requires all impacted companies to have at least one woman on the board of directors by December 31st of 2019, and it also requires that impacted companies meet additional requirements by 2021. So if the company has 6 or more directors, it will be required to have 3 female directors. If the company has 5 directors, 2 female directors, and if the company has 4 or fewer directors, it will be required to have 1 female director. So who are these impacted companies that are subject to the requirements? All publicly held companies incorporated in California and all publicly held foreign companies with a principal executive office in California are subject to the requirements. A publicly held corporation is considered one whose outstanding shares are listed on a major U.S. stock exchange, and the California Secretary of State's office has interpreted this as the New York Stock Exchange, the NASDAQ stock market, and the NYSE American, which is formerly the American Stock Exchange. On the other hand, corporations that are publicly traded but are not publicly held are not subject to this law, although those corporations are still required to file an annual corporate disclosure statement in California, so they may voluntarily disclose information relating to female directors. In the event an impacted company does not comply with the requirements of SB 826, the companies can be subject to certain fines. First, companies may be subject to fines for failure to have a female director serve during at least a portion of the calendar year, and those fines range from $100,000 for the first violation to $300,000 for subsequent violations. Companies may also be subject to fines of $100,000 for failure to timely file board member information with the California Secretary of State pursuant to a regulation adopted pursuant to SB 826. However, such regulation has not yet been adopted, so from a practical perspective, it's very unlikely that either of these fines will be enforced until the Secretary of State's office adopts those regulations. Since the California Secretary of State has not yet adopted implementing regulations, there's no official regulatory mechanism for reporting that would subject a non-compliant company to a fine. However, companies that are incorporated or headquartered in California are required to file the annual corporate disclosure statement that I mentioned earlier. And so this corporate disclosure statement is currently used to determine compliance. It was updated recently to include questions regarding the number of female directors that are currently serving on a company's board. So while we noted that the fines are not expected to be enforced for noncompliance in 2019, there are, of course, other negative consequences companies will likely face. Negative publicity is a big issue here, but also certain organizations like Institutional Shareholder Services, Glass Lewis, and major institutional stockholders have implemented voting guidelines that are unfavorable to companies with no women on their board. So now we'll take a look at kind of how effective this new law has been in achieving the goal of board gender diversity. Pursuant to this new law, the California Secretary of State must publish a report documenting the number of companies whose principal executive offices are located in California and to have at least one female director. They were required to file this report no later than March 1st of 2020, which they did, and from here on out, they will file this on an annual basis. The results of the March 2020 report showed that there were 625 impacted corporations in 2019. 330 of those impacted corporations filed a 2019 corporate disclosure statement. Of the 330 impacted corporations that filed the corporate disclosure statement, 282 reported compliance with the requirements. So this report shows an improvement over the July 2019 report that was published by the California Secretary of State. That report identified 537 impacted companies, and 184 of those companies were in compliance with the requirements. However, it's important to note that, rightly so, several articles written after the July report was published criticized the methodology and argued that the numbers weren't entirely accurate. If you have a chance to take a look at the report on the Secretary of State's website, you'll see it's not exactly user-friendly. It's, two separate spreadsheets that kind of don't give you a whole lot of information on how to interpret what you're looking at. The March 2020 report, however, was very user-friendly, so hopefully that's what we'll be using from here on out. But regardless, it's also important to note that the corporate disclosure statement currently being used to determine compliance is not due from companies until 180 days after the end of the company's fiscal year. So the information for many companies with fiscal, or possibly all companies with fiscal year ending December 31st, that's not yet available. So outside of California, the law has also been having a broader impact. California is, of course, the first state to implement this kind of law, but proposals have been introduced or considered in several other states, including Illinois, Massachusetts, New Jersey, and Washington. Over 244 of the California corporations in the Russell 3000 have added at least one female director since the law went into effect, and many have added 2 or more. As of mid-December, only 17 members did not have a woman on the board in 2019, which is an improvement from 93 in 2018. Further, women have accounted for about 45% of the new board seats among Russell 3000 companies based in California, which compared to about 31% nationwide. According to outside research, companies who have yet to comply with the requirements tend to be smaller in size. Researchers found that adding a board seat costs companies nearly $182,000 annually. And for smaller companies and startups with little revenue, that can be cumbersome and might explain the lack of compliance there. Also, 60% of women who joined the board of a California company had never served on a public company board, which indicates that there is a vast pool of women who are qualified to fill the board seats. And the only reason that I mention that is because it demonstrates that companies are not simply choosing women from the current pool of women that are already serving on boards, which was a prediction of critics of this new law. So while SB 826 is clearly making a positive impact on board diversity, it has faced opposition since it was enacted. California is facing 2 lawsuits opposing the law. The first was brought by a conservative activist group in August and claims that spending taxpayer money to enforce the law violates the California Constitution. The second was brought by a shareholder of a California-based company in November and claims that the law violates the Equal Protection Clause of the U.S. Constitution. The opposition is certainly not unexpected, but it is actually not as extensive as anticipated. California State Senator Hannah Beth Jackson, who co-wrote SB 826, told the Wall Street Journal that companies themselves haven't been fighting the requirements or opposing their need to comply. Interestingly, the company whose shareholder brought suit in November has also since added a woman to its board to bring it into compliance with SB 826. So although this new law faces opposition, the legal requirements, of course, remain in effect, and they are not expected to change. So companies, of course, need to take them seriously. The first step in ensuring compliance is to check the March 2020 report to ensure that all companies have been accurately reported. We've put a link here to make that as easy as possible. But in the event a company doesn't comply and has not complied with the requirements here, obviously we'll need to work to appoint a woman to the board as soon as possible and continue to work towards compliance with the additional requirements prior to the 2021 compliance date. If a company did not meet the requirements before the December 31st, 2019 deadline, but has since done so, it's important to file a new corporate disclosure statement noting that development Although it won't be reflected in the March 2020 report, of course, these corporate disclosure statements are publicly available, so that is a great way to show investors and others that the company is taking steps towards complying with the rules. That's all I have for today. Thank you.
Thank you, Kendall, and thank you to our entire panel for such useful and timely presentations today. In closing, as a reminder, if we did not address your questions during the call, we will follow up with you shortly by email. And also, please feel free to contact us directly with any additional questions or comments. On behalf of our presenters and all of us at McGuireWoods, thank you all for joining us today.